Hi, welcome to the final of the series of incomplete records, and probably the most difficult one. Very tricky question. Lots of little things you got to pick up. There's a spreadsheet here for you. I'm going to go through it. What we have is Farida does not maintain proper set of accounting records. Usual thing, of course, theme for the series. And here's the information as of the end of November 2023. So we have a statement of assets and liabilities, very different setup or starting point. So we start with a bank overdraft, cash in hand, fixtures. So very much, if you like, a liability, there's cash in hand asset, another asset, insurance paid in advance, asset, inventory, assets. And we've got a liability there. Telephone accrued, we owe that. Trade payables, we owe that. Trade receivables, very much current asset. And we got fixed assets, vehicles at net book value. Okay, let's go further. We've got information, some cash drawings, and we made some payments to our suppliers in this case, and we've got money coming in from our customers. Further information. All sales and purchases did not involve cash. Excellent, makes it a little bit easier for us. All goods are sold with a 25% gross profit for gross profit. So what we're looking at then is our cost of sales must be 75% of the revenue received. That's going to be important information later on. No record was taken on goods taken by Farida. There we are. That adds to a little bit of a complication. And no additional capital, don't mind, was invested into the business during the year. Required an income statement up to the point of determining the gross profit and make sure that we show the goods taken for own use. So let's get going on this. Well, the revenue, this will be the money coming in from our sales. So now, as is always the theme, spend time reading the case study data. So you get a feel inside what's going on. Receipts from trade receivables. There we are. We're looking for that. Here's the figure we want. 51,570. Okay, that is the money we collected from our customers. But at the end of the year, okay, we have to take this 40. So let's get the date right. Okay, because this, I'm going to put in there, this is the closing amount. Now, why we put that in, we add that in, because we sold the goods, we just haven't collected the money yet. But for the start of the year, the reality is that money collected, 3,430, was from the previous year's sales. We can't double count that. That belonged to last year. So the net revenue from sales was 52,200. Now remember, that's the actual income. The gross profit, cost of sales, is actually 75% of that. It's going to come in rather handy. Right. So just bear that one in mind. Money coming in, closing balance, we have to add on, take away the closing balance. So where are the cash sales? There were none. We were told that in one of the notes. That's what I said. Note 1, no cash. Great. So that looked quite simple. What about the income? Now, the revenue, let's be a bit more specific, from sales. But in fact, it's from credit sales. That's just me being a little bit pedantic, but I don't think that would affect your marks. I didn't add it. Now this is the income. Okay, the income, which we will work on in a minute. So the revenue now is 52,200. So there's our starting point now. So what was the opening inventory? Okay, well, we've got a figure here of 6,160. Look carefully, where did that come from? So sales revenue, opening, and what about the purchases? Okay, where did that come from? So have a think about that. Right, come back to that in a minute. It's up here. So I've written it in blue because it needed to be worked on. Calculation of purchases. Well, what did we actually pay? 37,685. Where did that come from? Okay. There's your figure. Payment to the debtors. It's down here. That's what we paid. But we had a figure we carried down, 1685. Where did that come from? There's that figure there, if you can see it on the screen. Okay. We actually bought those goods. We just haven't paid for them yet. So that's got to be included in our purchases, but we take away what we started with because that was last year's purchases. And again, we can't double count that. You must not bring that into this year's purchases. Otherwise, you'll have counted it last year and this year. Not allowed. So the net purchases is now this figure here, 36,795, which we can carry over to the purchases here. Now, we have to take away, this was something also dealt with in the last two examples of incomplete records, where if the owner of the business helps themselves to the goods, so they're entitled to it, it's their business, providing it's accounted for, but we mustn't include it in the income because it's actually drawings. So what have we got? We've got to work on it. Well, there's the sales revenue. We're taking away 25%. So the actual cost of sales was 39,150. Now, the purchases, 36,795. Where did we get that figure from, you may ask? That's from here. Opening inventory, closing inventory. The missing figure, okay, is 1265. So The cost of sales, the goods that we paid 39,150. That's the value of the goods that we paid. So all the stock that we had, okay, our cost of sales and the revenue. And we actually bought 36,795. That's what we got there. So with the opening and closing inventory, we are short on goods of 1,265. That's where that figure came from. So opening stock plus purchases minus closing stock less what he took, we've now got an income of 39,150. There we have it. Okay. Now, let's take it a bit further. I want a statement of affairs, just as you thought it was a statement of affairs similar to a balance sheet. We want the assets and the liabilities. So again, take this sheet, play around with the data. I'll adapt it so all this is lifted from the other sheet. So what you change on one will ripple through into the final statement of affairs, which is what this is. Okay, well, on the assets, read through it. Okay, we've got fixtures, inventory. So we've got opening, closing, insurance paid in advance. Remember, that is very much an asset. Trade receivable. So here are the assets added up. That's for the beginning. And that's that's at the end, the closing. Liability is exactly the same. These figures are just lifted straight from the information given. Okay, now, what about the capital? Okay, well, there we've got it. That's your assets. And that's your liabilities. So assets less liabilities gives you, let's tidy up these figures. Gives you the net capital. Okay, that's useful. That tells us what the business is actually worth. So what about the profit for the year? Well, we start with the opening capital. Profit, 5,920, less the drawings, gives us closing capital. So let me at least correct that one, because that is actually a statement of closing capital. And there we have it. You've watched me fiddle around with the spreadsheet, make a few little alterations, and that is for your benefit to play around with. Now, to end the series, there'll be plenty more. I shall develop a series of examples with other parts of the A-level and advanced accounting, whatever you're doing, whether it's UK A-level, international examinations. It's all very much a universal subject, but please, the only way you're going to succeed with this is practice, practice, practice. To pull down the past papers of examining from whatever examining board you're using and look at those schemes, and here's the spreadsheets, and hopefully you've learned something from all this. Okay, good luck with your studies.